Welcome to our channel. Today, we're diving into a topic that affects everyone: tax myths. You might be surprised to learn that many people hold misconceptions about taxes that can lead to costly mistakes. From the belief that you can't deduct home office expenses if you're self-employed to the idea that filing taxes is optional if you earn below a certain amount, these myths can cloud your judgment and impact your financial decisions. In this video, we'll debunk some of the most common tax misconceptions, providing you with the facts you need to navigate the tax landscape confidently. Understanding the truth about taxes is crucial for making informed financial choices, whether you're an employee, a freelancer, or a business owner. By clearing up these myths, we aim to empower you to take control of your finances and maximize your tax benefits. So, stick around as we unravel the truth behind these tax myths and help you make smarter financial decisions. Myth 1. All tax refunds are free money. Let's tackle a common misconception: the idea that tax refunds are free money. In reality, a tax refund is simply the government returning your own money that you overpaid throughout the year. When you have too much withheld from your paycheck, you're essentially giving the government an interest-free loan. While it might feel like a windfall when you receive that refund, it's important to understand that it's your hard-earned cash coming back to you. This overwithholding can have significant implications for your personal finances. Instead of waiting for a refund, you could have that money in your pocket throughout the year, allowing for better cash flow and more opportunities to invest or save. To optimize your finances, consider adjusting your tax withholdings. By doing so, you can keep more of your money in your paycheck, giving you greater control over your financial situation. Remember, a tax refund isn't a bonus, it's just a return of your own funds. Myth 2. You can't deduct home office expenses. Let's clear up another common myth: the belief that you can't deduct home office expenses. In fact, if you meet certain criteria, you may be eligible for significant deductions. To qualify, your home office must be used regularly and exclusively for business purposes. This means that a spare bedroom or a dedicated workspace in your home can qualify, but a corner of your dining room table likely won't. It's important to note that the rules differ for employees and self-employed individuals. While self-employed individuals can deduct a variety of home office expenses, such as a portion of rent, utilities, and internet costs, employees can only claim these deductions if they meet specific conditions, such as working from home for the convenience of their employer. Examples of deductible expenses include a percentage of your mortgage interest, property taxes, and even office supplies. By understanding the rules surrounding home office deductions, you can take advantage of potential savings and reduce your overall tax burden. Myth 3. Tax preparation. Software is always accurate. Many people believe that tax preparation software guarantees accuracy, but that's not always the case. While these tools can streamline the filing process, they are not infallible. Errors can occur due to incorrect data entry, outdated software, or even misunderstandings of tax laws. It's crucial to remember that the software is only as reliable as the information you input. To ensure your tax return is accurate, take the time to double-check all entries and familiarize yourself with your tax situation. Understanding your deductions, credits, and overall financial picture can help you catch mistakes before they become costly issues. For more complex tax situations, such as owning a business or dealing with significant investments, consulting a tax professional can be invaluable. They can provide personalized advice, help you navigate intricate tax laws, and ensure you're maximizing your deductions. While tax software can be a helpful tool, it's essential to approach it with caution and seek professional guidance when needed. Myth 4. You don't need to file if you're below a certain income. A common misconception is that low-income earners don't need to file taxes, but this isn't entirely true. Filing requirements are based on specific income thresholds, which can vary depending on your filing status and the types of income you receive. Even if your income falls below these thresholds, you may still be required to file if you have self-employment income or certain other types of income. Moreover, there are significant benefits to filing your taxes, even if you're not required to do so. Many low-income earners may qualify for tax credits, such as the Earned Income Tax Credit, EITC, or the Child Tax Credit, which can result in a refund that exceeds the amount of taxes withheld. By filing your taxes, you open the door to potential refunds and credits that can provide much-needed financial relief. So, take the time to check your eligibility for these benefits. It could lead to extra money in your pocket. Myth 5. Tax audits are common and random. Many people fear tax audits, believing they are common and happen randomly. In reality, audits are relatively rare and typically triggered by specific factors rather than being random occurrences. The IRS uses various criteria to identify returns that may warrant further examination, such as significant discrepancies in reported income, unusually high deductions, or patterns that deviate from the norm. Understanding these triggers can help you file your taxes more confidently. Proper documentation is key to avoiding issues. Keeping accurate records of your income, expenses, and deductions can provide the necessary support if your return is questioned. It's important to reassure viewers that the majority of taxpayers will never face an audit. In fact, audit rates are quite low, especially for those with straightforward tax situations. By staying organized and informed, you can minimize your chances of an audit and focus on what really matters, making sound financial decisions and enjoying peace of mind during tax season. Myth 6. You can't claim medical expenses. A common misconception is that you can't claim medical expenses on your taxes, but that's not true. In fact, many medical expenses are eligible for deduction, provided they exceed a certain percentage of your adjusted gross income. Qualifying expenses can include a wide range of costs, such as doctor visits, hospital stays, prescription medications, and even certain long-term care expenses. To take advantage of these deductions, it's crucial to keep thorough records of all medical expenses throughout the year. This includes receipts, invoices, and any relevant documentation that supports your claims. Having organized records not only simplifies the filing process, but also ensures you can substantiate your deductions if needed. We encourage viewers to explore all potential deductions related to health, as many people overlook eligible expenses. By understanding what qualifies and maintaining accurate records, you can maximize your tax benefits and potentially reduce your overall tax liability. Don't miss out on the savings that could come from claiming your medical expenses. Myth 7. Student loan interest isn't deductible. Many people believe that student loan interest is not deductible, but this is a misconception. In fact, you can deduct up to $2,500 of interest paid on qualified student loans, which can significantly reduce your taxable income. To qualify for this deduction, the loan must have been taken out solely to pay for qualified education expenses, and you must be legally obligated to repay the loan. However, there are income limits that affect eligibility for this deduction. If your modified adjusted gross income, MAGI, exceeds certain thresholds, the deduction begins to phase out. For single filers, the phase-out starts at $70,000, while for married couples filing jointly, it begins at $140,000. If you fall within the income limits, we encourage you to take advantage of this valuable deduction. It can provide much-needed financial relief as you manage your student loan payments. By understanding the criteria and keeping track of your interest payments, you can maximize your tax benefits and ease your financial burden. In today's video, we've debunked several common tax myths that can lead to misunderstandings and financial missteps. We clarified that tax refunds are not free money, explained the eligibility for home office deductions, and highlighted the importance of accuracy in tax preparation software. We also discussed the misconceptions surrounding filing requirements for low-income earners, the rarity of tax audits, the deductibility of medical expenses, and the benefits of claiming student loan interest. Being informed about these tax facts is crucial for making sound financial decisions and maximizing your potential savings. Understanding the truth behind these myths can empower you to take control of your finances and avoid costly mistakes. If you found this information helpful, we encourage you to subscribe to our channel, like this video, and share it with friends and family. Together, we can spread financial wisdom and help others navigate the often confusing world of taxes. Thank you for watching, and stay tuned for more insightful content.